Okay, welcome back. In the previous exercise, we looked at some source documents and we determined for each transaction which cycle we were impacting, the selling cycle, the buying cycle, or the financing cycle. And then we also said, what did we get and what did we give? The next step is we are going to go through each of those same transactions. I have them listed out here on the left-hand side. And we're going to start associating those transactions with the accounts that are impacted, and we are going to determine if we are going to increase that account or decrease that account. So let's get started. Transaction 1, we issued stock in exchange for an investment of $100,000. So we received cash of $100,000. We're going to increase cash. And we issued stock, so we're going to increase stock. You'll notice that this transaction log follows the accounting equation. Assets equal liabilities plus equity. We are going to want to make sure that whatever we do on the left side under assets equals whatever we do on the right side under liabilities plus equity. The other thing is we're never going to directly impact equity. If we need to impact equity, we will impact either stock, dividends, revenue, or expenses, and then we will carry that over to the equity column. So for example, stock increases equity. So we're going to enter our $100,000 in the equity column. So we have positive $100,000 on the left side, positive $100,000 on the right side, so we're in balance. When we're comparing the right and left side, we're only going to go through column I. Columns J through M, those are more like sub-accounts that impact equity. So we'll carry over the impact to equity, and then that's what we'll look to compare. Okay, transaction number 2. We bought inventory for $10,000 cash. So we increased inventory by $10,000 and we decreased cash by $10,000. All right, so that should be negative. All right, so the net impact to assets is 0. We increased an asset for $10,000 and we decreased another asset for $10,000. We didn't do anything on the right-hand side, so we have 0 compared to 0, and we're in balance. One quick note, you see the parentheses on the $10,000 decrease to cash. In accounting, rather than using a minus side, we use parentheses to indicate a negative number. Transaction 3. Falcon Inc. buys equipment for $60,000 in exchange for $60,000 in cash. So we are going to increase equipment by $60,000. And we're just going to fix this one. There we go. And we decrease cash by $60,000. Net impact of 0 on the left side. We didn't touch the right side, so that's 0, and we're in balance. Transaction 4. Falcon Inc. buys inventory for $20,000 on account. So we're going to increase inventory by $20,000. On account means that we, instead of paying cash, gave a promise to pay at a later date. When we're in the buying cycle, we call that promise to pay accounts payable. So we're going to increase accounts payable because we now owe money. On the left side, we have a positive $20,000. On the right side, we have a positive $20,000, so we're in balance. Transaction 5. Falcon Inc. sells consulting services for $30,000 on account. Okay, so first of all, to sell the consulting services, we are going to increase revenue. Revenue increases equity, so we are going to increase equity. On the other side, we sold them on account, which means we didn't receive cash from our customer, but rather we received a promise to pay. When we are in the selling cycle, a promise to pay is accounts receivable, so I'm going to enter $30,000 positive in accounts receivable because we are due money in the future. We've impacted the left side with positive 30,000 and the right side with positive 30,000, so we are in balance. Transaction number 6. Falcon Inc. pays its employees $5,000. When we pay our employees, we call that payroll expense. So we're going to go over to expense and put $5,000. Expenses decrease equity. So under equity, we're going to put negative $5,000. We're also going to decrease cash by $5,000 because when we pay our employees, we always pay them cash. So we have negative 5,000 on the left, negative 5,000 on the right, so we are in balance. Transaction 7, Falcon Inc. pays rent of $2,000. So we always pay our rent in cash, so we're going to do negative 2,000 in the cash column. Rent is also an expense. We call this rent expense. So we have positive expense. But expense decreases equity. So under the equity column, we're going to put negative 2,000. We have negative 2,000 on the left, negative 2,000 on the right, so we are in balance. Transaction 8, we are going to sell consulting services for $40,000 on account. So this will look just like transaction 5, but with different numbers. So our accounts receivable will increase by $40,000 because we received a promise to pay. And in the selling cycle, a promise to pay is accounts receivable. We also will increase revenue by $40,000. Revenue increases equity, so we'll put positive 40,000 right there. Left side has positive 40,000, right side has positive 40,000. We are in balance. Transaction number 9, Falcon Inc. buys a yacht for $250,000. And this should say on account because we don't actually have $250,000 in cash. So we are going to put that yacht in equipment. So we increase equipment by $250,000 and we're going to increase our accounts payable by $250,000 because we're going to pay in the future. So we owe more money. We have positive 250 on the left, positive 250 on the right, so we are in balance. Transaction number 10. We are buying t-shirts for $1,000 on account. The t-shirts are distributed immediately, so they're an expense, meaning they have no future economic value. If we were going to hand them out next month, they would be an asset, but because we've already distributed them, we've already gotten the value from those t-shirts, we're going to call them an expense. So we're going to put $1,000 as an expense. Oh, my goodness, this thing is going all over the place, isn't it? $10. And we are going to increase expenses by $1,000. Expenses decrease equity, so we're going to put negative $1,000 in equity. And since we're going to pay later, we're going to call that accounts payable. We're increasing our debt by $1,000. The left side has no transactions, so it's 0. The right side has an increase in liabilities and a decrease in equity, and they net to 0, so we are in balance. Transaction 11. Okay, here we go. Transaction 11, we collect cash related to transaction number 5. So that's going to be $30,000 that we collected. When we collect cash, we increase cash by $30,000. And then we decrease accounts receivable. So if you think of accounts receivable like an IOU, when we booked transaction 5, the customer gave us an IOU and said they're going to pay us $30,000 later. When we actually get the cash, we give back the IOU because they no longer owe us any money. On the left side, we net to zero. We didn't book anything on the right, so we are in balance. Finally, transaction number 12. And we are going to pay a dividend equal to 1/2 of net income for the period. Okay, so before we can determine what we're going to increase and decrease, we need to determine the amount of net income. So net income equals revenue minus expenses. So if I go down here, my revenue, I look, is 40,000 plus 30,000. That's going to be 70,000. My expenses, 5,000 plus 2,000 is 7,000, plus 1,000 is 8,000. So minus 8,000. Okay, need to do some formatting here. So we'll just do that really quick. All right, so our net income is going to be 70,000 minus 8,000, or 62,000. We are paying a dividend of 1/2 of net income. So our dividend is going to be net income divided by 2. And that's going to be $31,000. Okay, so now to book that, we're going to increase dividends by $31,000. Dividends decrease equity. So that's going to be negative $31,000 in equity. We're going to pay this dividend in cash. So negative 31,000, because we'll decrease our cash by 31,000. So on the left side, we have negative 31,000. On the right side, we have negative 31,000, and we are in balance. That concludes our transaction log. In the next video, we will look at how to turn our transactions, our increases and decreases, into journal entries.